Hello, YouTube and X. It's your main man BTM here, bringing you back to the BTM Crypto News Network. And today we're having the Fed a FOMC meeting. And this is the biggest meeting we've had all year because it's coming down to if the Fed is cutting the interest rate, and there will be massive impacts on what the Fed does today. So again, this is the biggest Fed meeting of the year. This is one of the biggest impacts ever. I think the meeting starts at 1:30. And actually, it used to start at 1, but even when it starts at 1:30, they're going to talk before he just comes out. He doesn't come out and just say, we're cutting the interest rate or we're not cutting the interest rate. It gives you a whole synopsis of life, liberty, and the pursuit of happiness before he gets to that. But let me start the screen share and see what we can see. I'm going to start with this CNBC News for a second, and then I guess we'll go to this live stream from Bloomberg. And this is the actual meeting. I guess the meeting started. Let me see. Let me double check. It does not appear because when the meeting starts, this feed turns on. And I guess not. I guess it's not started. But everyone's looking at the same feed. So this is actually on the federalreserve.gov website. So let's see. Let me know in the comments. Do you think he's going to cut or don't cut? I personally think he's going to cut this 0.25. If he does cut, and there's rumors floating around, he might not even cut just to stick it to President Trump. But let's see. Dior, what's going on, man? Let's go cut ZBC into the effing moon. Please and thank you. Please and thank you. Cuts are coming. I hope so, Dior. I hope so. Let me click to this real quick. And I'll double check and be back shortly.
Market moves ahead of one of the most highly scrutinized Fed meetings of the year. The central bank widely expected to cut rates by 25 basis points tomorrow, its first cut since December, amid continued pressure from President Trump. While major averages were a little changed today, gold settled at its 35th record of the year. The dollar traded near more than 3-year lows, and rate-sensitive regional banks got hit hard. Bank First, Synchrony Financial, Huntington Bankshares, KeyCorp, among the worst performers in the group, but with broader markets near all-time highs. What do these moves tell us? What do you think is telegraphing?
Well, it's the gold market's telling something, I believe. I said that for a while. Now, that's been wrong to say that for a while because the equity market, the S&P made a new all-time high today. So clearly there's some disconnect. But the fact that gold goes up seemingly in every environment we can think of is somewhat problematic, I think, if you look at it long term. It's trying to tell a story. And the fact that the dollar has had no bounce whatsoever outside of maybe a 3 or 4 day period a couple of weeks ago should also be concerning. Now, people will say a weaker dollar supportive of equities. I agree with that to a point. You hit that diminishing marginal return, and I think we're pretty close. The pound feels like it's going to 125. Dollar yen feels like it's going to breach 140, and I think the equity market will wake up and say, you know what, maybe it's not such a good thing.
Yeah, there are big moves in the regional banks, and you would think that they'd be a beneficiary of a better economic environment.
Yes, although I guess, I mean, if you look at how far they've run since, Liberation Day, they're up maybe 40%, which is huge. So I don't know, some of it is maybe just giving that back. But I was surprised how hard they got hit today.
Yeah, and I think one of the question too is what's going to happen with the longer term side of the curve, because realistically, the Fed is cutting into a really strong economy. And what that can do is spur a lot of increased activity in the markets, increased activity in the economy, actually increase longer term inflation. Like you can get this melt up. And historically speaking, when the Fed cuts in a strengthening economy, the markets are higher 12 months later, but so might be the longer end of the curve, which also can affect like mortgage rates. So you actually might see less mortgage demand, those rates go higher, and that actually could be part of the story.
Yeah, that was one of the points Julian Emanuel made this today on the exchange. 12 months out, 12 months out,
Yeah.
markets are higher.
Were you hosting that show?
I was with
You was.
Santoli.
Yeah, that's great. I was watching.
I'm sure you were watching.
I was watching Squawk Box this morning, and Treasury Secretary Bessent was asked that question by Becky Quick about it was September of last year. The Fed cut rates, the 10-year yield went higher. What are your thoughts? He said it was different this last year. We're in a much different environment. We will see. But I share the same concerns that, people getting ahead of themselves in terms of rates continuing to go down. I still am one of the few people that think 10-year yields are going higher from here.
Yeah. What do you think, Dan?
Yeah, we haven't even mentioned the Lisa Cook situation. We haven't mentioned that this is literally a case that is going in front of the Supreme Court that might actually change the course of the makeup of the governors tomorrow at the meeting. I mean, that's just insane to think about. And so, listen, we got this 4% in the 10-year. We've seen yields kind of run ahead a little bit of a very telegraphed 25 basis point cut here. I'm kind of in Guy's camp here. I mean, and I'm not sure I agree with Courtney that the Fed is cutting into a strong economy. It would just kind of be at odds with what we've just seen in the labor market over the last couple months and the revisions back to June. You tell me there's strong retail sales, back to school, this and that, whatever. I'm like, well, that's what Americans do. We buy crap, And so at the end of the day, if the labor market is weakening, you're going to see other parts of the economy weakening. And then it comes back to why the Fed is cutting right now. And if they cut, do we see inflation pick back up? So at the end of the day, I think it's about as clear as mud. I think that we were going to be talking about this Lisa Cook and Moran situation tomorrow, especially if you have a Supreme Court rule that this person, this governor, cannot vote at this meeting tomorrow. I mean, it's just insane. We're within 24 hours. I saw the bug up there, the 20 hours and counting down.
Okay. So I'm not sure what that disclaimer is for as well. For some reason, I can't stream and watch, or you
If you
can't
look at
see me
the CME Fed Watch,
while it is streaming. So I don't know. We go to this halftime report, or do we go to Bloomberg? But let's check the Fed playback issues. Are we started yet? Let me see. Sounds like something's happening. Got 5 minutes to 1:30. So I guess we'll go back to this other video. What is this? Bloomberg Live or CNBC. I guess we'll play this for a minute while we're waiting. But for some reason, I have to
96% chance, 25 basis point cut. It seems to be the consensus. We're going to get something. It's 50 basis.
That's weird. I don't know why it does that. But
Points possible.
I don't think so. I think you get 25 basis points. And I think the more interesting dynamic surrounding this afternoon's Fed meeting is how many dissents do we get? We potentially could get 3 dissents. That's the first time since 1988. The dissents will be regarding what you're speaking toward, which is we should get a 50 basis point cut. So I'm interested to hear from Steve at some point.
Brock, that's a good question. I don't know. I actually recorded it. So if you guys want to watch it, we can, or we could play it live. I don't know. I was going to use it and create some shorts. I was going to chop it up and make shorts, but I guess we can play it live as well. Let me get back to this real quick.
What he thinks they should be doing with the balance sheet. We've run it down to somewhere around 6.6 trillion now. Maybe we need to start buying MBS instead of letting those securities run off. But I think today is going to be about a 25 basis point rate cut with dissent.
All right. I believe we have Steve Leisman back in DC. Technical difficulties resolved. Steve, coming back over to you. I'm going to ask you the same question that Joe just answered. Is that 50 basis point cut potentially on the table here?
I think it's on the table for maybe people who want to dissent, Frank. I don't think that's where the Fed is going here. They go into this meeting, you have a couple lackluster job reports. You got a pivot by Fed Chair Jay Powell and Jackson Hole towards the dovish side. Markets have confidence in the cut today and two more this year. So I just want to go through, Frank, real quick, how the Fed might signal more cuts to come. Three places to look. Look at the level of concern with weak jobs versus sticky inflation from tariffs. Look for changes to the dot plot. It's going to show the rate outlook for the committee. And look for potential dissent in this regard, showing how much leaning there is for tighter or looser policy on the margin. Back in June, it's the latest Fed forecast. 7 officials saw no cuts this year, 8 forecast 2. That made the median just barely 2 here. That could go to 3 today from the market's view of multiple cuts this year. Another issue, the one Frank brought up, possible dissent in favor of 50 basis points cut. But there you see Stephen Myron, the new Fed governor, unpaid lead absence from CEA, sworn in as Fed governor right there. Reflecting President Trump's desire. Does he reflect his desire for a drastic decline in rates? He could be joined by 2 other Trump appointee governors, both of whom are candidates for Powell's job as chair. It may be offsetting that, though, a dissent on the more hawkish side from some Fed members more worried about inflation than jobs. So a rare possibility of dissents on both sides, Frank, unless Powell does what he often does, find a way to forge consensus on the committee. I don't think that consensus, Frank, is in the 50 basis point rate cut today.
All right, I want to go to Jay Powell, the press conference, obviously after the rate decision. How do you expect the tone to be? Could we potentially see a hawkish cut here? And if so, what would be, Jay Powell, in your mind, with your expectations, what would he be focused on? Because a lot of concerns about stagflation, but just yesterday, we got a much better than expected retail sales report that seems to signal at least more strength in the economy than we fear.
Yeah, this is weird. I see the Atlanta Fed GDP now running at 3.3%. For the third quarter here. And I see a lot of economists on the street with a 1.5% full year GDP number. So we're going to have a real slowdown in the fourth quarter to get there, or we're not going to have that slowdown. I really think Powell's going to try to be measured here, give the market the minimum of what they want, hold open the possibility of additional cuts this year, but not necessarily promise it outright, because I think he wants to hold on to the flexibility. If things coming in, Frank, the way you suggest, stronger than expected, if that inflation from tariffs ends up being worse. Our CNBC Fed survey, Frank, I think it's important, said substantial amounts of price increases are yet to come from tariffs. There's a limit to the extent to which the Fed is going to be promising much lower rates while that inflation rate is moving away from its target of 2%.
All right, Steve Leisman live in D.C. Stephen, I got to get over to the Fed for that decision in the news conference. Thank you again. Liz, I want to come over to you. Just talking about a little bit about what Steve talked about, these dissenters. We're going to get that dot plot.
Yep.
There's potential for some of these dots to be just kind of out of the range of the rest of the group. What would that signal to the market?
So the dot plot in June they had a lot of dispersion. It was really heavy on the no cut side and then really heavy on more cuts. So what I think we'll see this time is, first of all, base case being, I don't think a lot changes. And
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable
here we
prices
go.
for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed and downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In support of our goals and in light of the shift in the balance of risks, today, the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the marked slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effect could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has continued, kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Okay, and then just as a quick follow-up, I'm sorry, can you and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, and tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thanks.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible and that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply, and to the point where we see what I've called a curious balance. It's, you know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Nick Timrose of the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. But what we can say is this: that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved, I think we're now reacting to, to the much lower level of job creation and other evidence of softening in the labor market, and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting, and now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off, and that tells you that it's time to take that into account in our in our policy.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off a series of cuts at this point.
Yeah, so I would look at it this way. We fully understand and appreciate that we need to remain fully committed to restoring 2% inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risk to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risk.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by your explanation of the Fed cutting rates because of unemployment. If you think that most of what's happening in the employment area is related to immigration, which your rate cuts wouldn't address, how do you see that as more important than inflation, which has remained almost a full percentage point above your target?
Well, I was saying that what's happening in the labor market has more to do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
Like a follow-up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028, at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create, over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that though, right? We have to. Our job is literally to make sure that that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The path through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, our policy had been really skewed toward inflation for a long time, really. Now we see that there's downside risk clearly in the labor market, and so we're moving in the direction of more neutral policy.
Concerned are you about the slowdown in the jobs market for households at home, especially younger Americans struggling to land a job?
So it's an interesting labor market, and obviously we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market. You see people who are sort of more at the margins, so kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting.
Okay, guys. So we did get a 0.25 interest rate cut. So we'll see how the market reacts. I'm gonna see if I can try to pull up the video for the actually run the AMA real quick. See if I can get it set up for 2 o'clock and we can go through that real quick. Let me know in the comments. If not, hang tight. Thanks for joining, and I will see you at 2 p.m. Central Standard Time. It's your main man, BTM, signing out. And remember, let's get back to the money and stay dangerous. Miner out. Got to add the exit video. I took it off. All right. Again, trying to get back by 2 o'clock, and we'll see you shortly.